Good morning or good afternoon for those of you who are in Europe. We're doing now the Super Return webinar, Redefining Private Credit. What are the new strategies on offer? Thank you all for logging in and attending the webinar. Today we're going to have three speakers covering some topics. I'm Kelly DePonte. I'm the Managing Director of Probitas Partners, which is a placement agent, and I'll be providing an overview of some of the things that are happening in the larger private debt markets now. Then we'll have as speakers David Bateman, who's a Senior Managing Director of Harbert European Growth Capital, and David will be speaking on the topic of providing growth capital to tech companies and discuss the evolution of this strategy and the skill set required. Then we'll be having James Newsome, a partner with Arbour Partners. James will be providing an overview of SME platform lending and evaluate how these platforms are adding a second dimension to the private credit market. First of all, I'm going to be presenting you with some numbers as to what's going on in the overall private credit markets. The slide up shows you fundraising trends over roughly the last 15 years or so in this sector. And a couple of things to point out. First of all, due to secular changes in the marketplace, this has been a sector which is growing tremendously. If you were to look at a same chart for the private equity market, you would see that fundraising in 2017 basically came back to its pre-Great Financial Crisis numbers, the numbers of 2007, 2008, whereas the private credit side has reached nearly twice as large as it was before the Great Financial Crisis. This market is one that, in its earlier days, was really driven more by mezzanine lending. But because of the changes in the market after the Great Financial Crisis, direct lending has become one of the largest areas. The other areas here on this chart, venture debt, energy debt, and royalties, are all smaller subsets of the market. Venture debt being heavily driven by equity warrants, actually. Energy debt being listed separately simply because there aren't that many funds that focus on a particular industry sector as energy does. And the royalty area is another one which is smaller but has also gone through some changes. One of the things I should mention is when looking at areas like direct lending, is direct lending now is different than what it was 5 years ago. 5 years ago, this was mainly a market focused on senior debt, and as investors have looked increasingly for higher returns, they are moving into things like unitranche and subordinated debt as part of these direct lending funds, so that the risk-return profile of direct lending in 2017 is much different from what it was in 2012. On a geographic basis, the largest funds in the market tend to be global, or more particularly really sort of transatlantic, focusing on North America and Europe. There is not that much activity in Asia and other markets. The market began its roots mainly in North America, but notably over the past 5 years, there has been more and more interest in Europe as a market leader, especially on the direct lending side. One other thing to note is that there are some investors, some institutional limited partners, who look at the market on a broader basis and do include such things as real estate debt and infrastructure debt funds as part of their debt profiles, though there are many other people that consider those funds either part of infrastructure or part of real estate. The other big area, however, is distressed credit fundraising. There's a slide up here which tracks the trends there, but there are investors who consider distressed debt, which is focused on corporate credit, opportunistic credit, which is focused really more on investments that are in things like asset-backed securities, whole lending portfolios, but non-corporate debt. A lot of that is the focus of opportunistic credit is in investments like that. And then special situations funds, which will invest in stressed credit, very often new high-yield credit to investors, along with taking positions in distressed debt as well, all within the same vehicle. One thing I should mention is that turnaround funds that also show up on this chart really are more the purview of equity funds, making equity investments, so that they would usually not end up in the distressed credit bucket. That gives you a brief overlook of the market as it exists now, and we're now going to be talking about some of the newer areas that are beginning to develop in the credit space. So, David, if you could begin covering your topic.
Thanks very much, Kelly, and good afternoon, everybody. My name is David Bateman. I'm running a growth lending strategy on the Harbert platform for the last 5 years, and for the previous 10, was one of the founders of a business called ETV Capital that did direct lending from 2002. We fit as a strategy in one of those direct lending buckets that Kelly was talking about earlier. The slide you have now should show you sort of the high levels of what we do. So we basically provide bilaterally negotiated loans with equity kickers attached to European growth companies. Overwhelmingly, they are technology or life science businesses. One of the things that's distinctive about our companies from a lending point of view is that most of them are not profitable at the time that we lend to them. And we effectively monetize and generate our alpha by having various skills and history and domain expertise and filters that allow us to identify companies that are still creditworthy before they have begun to generate cash profits. That's obviously heavily linked to the value of the intellectual property and the progress and the revenue growth and the gross margins that these companies generate. And we have over a 16, 17-year period developed a reliable model of being able to lend to these businesses. We also take equity kickers, and we therefore generate a blended return. Our asset level returns are in the sort of 18 to 22% range, and when you put that through our fund and discount for fee carry and all the other usual private equity structural points, we come out at the type of returns that are being shown here. We have a long track record of doing it. We're currently running the second fund on the Harbert platform. In terms of what it means, kind of for Europe and our sort of addressable market, we're very much a European fund, to the points that Kelly was making about where the growth has been, etc. One of the things we do, and we are not unique in this, we lend across multiple jurisdictions in Europe, and that in itself is not always straightforward and is also kind of partly a source of return. It gives us the opportunity to arbitrage across various European markets where the market conditions may differ, and there are opportunities relating to that. In terms of the type of lending, it's overwhelmingly corporate lending, and lending to a certain type of corporate. So in general, our businesses are generating revenues and fast revenue growth, anywhere from 5 up to maybe as much sometimes as 100 million of revenue. Growth rates might be anywhere from 15 to 20 up to the sort of 100% growth for very exciting sort of businesses. And the gross margins are in, generally speaking, the low end maybe 40, and at the high end maybe 80 to 90%. With those gross margins and that type of revenue growth, effectively, as you can probably tell, part of our model is that these businesses will rapidly become profitable even if they are not when we lend to them. And we're also assuming in our own credit thinking that there's an active M&A market for these businesses, and generally speaking, we're symbiotic with the equity shareholders. The equity shareholders are trying to grow these companies to be much larger, and along the way, find exits for them. Their targets are much more than we actually lend to these businesses. So, this gives you a picture. It is geographically Europe, but it is also overwhelmingly Western and Northern Europe where we tend to lend. We also lend to publicly held businesses as well as privately held businesses. There's a significant number of listed smaller cap European technology companies that we can achieve the same type of outcome. Situationally, and I would stress our strategy is quite situational in nature. This slide tells you roughly where in the lifespan we tend to lend. There is a phase of what we do that is simply too early, where these companies probably are still being supported by venture capital firms, and they're being grown from, if you like, from an acorn, usually where there's zero revenue and very high burn, to an inflection point where we start to come in, where, as I said earlier, the revenue's usually anywhere from sort of 5 to 15 to 20 when we first come into a company. And then at that point in time, as you can kind of see from the red line underneath, the burn rate starts to fall, the revenue ramp goes up, and that's the kind of phase in which we operate with our growth lending. One thing to point out, there's if you look at our business, there's roughly there's roughly two types of deals. What we call our growth debt deals, where we're funding the organic growth of the business. There's also a slice of our business which is acquisition finance, which is common to many other corporate lenders, where in fact we're financing effectively, cash payments to selling shareholders when one private company is merging with another, and that represents, in any given period, anywhere from 20 to 40, or sometimes as much as 50% of our lending, as those deals tend to be larger on average than the other deals. This is a sample, I suppose, what we wanted to put in front of people of one type of strategy. There are, of course, many others, and I'm going to pass on the speaking now to James Newsome, who is aware of a number of other types of platforms that probably are larger than ours, and that you probably see, many other parts of Europe. Thank you.
Yeah, thanks, David. James here. So, yeah, shifting gears in some ways, but in other ways not. So what I'm going to talk about here for 5 minutes or so is about how technology is enabling credit sources and credit monitorers to do a lot more with SMEs, which of course previously, particularly in Europe, were hidden behind the iron curtain of the banking system. So now over the last 5 years, there's been a significant change in the sense that technology and data is getting institutions access to SME credit. The actual SME credit itself is pretty simple. We're talking about loans of less than €1 million or less than £1 million to SMEs in typically about a 4 or 5 year loan. But the actual use of technology itself is where the innovation is coming. Very briefly, looking at this chart here, this is kind of a vision of the future for direct lending. The data-led lending, which I'm talking about now, is sometimes referred to as direct lending 2.0, and you can see in the chart here that really what David is doing and pioneering extremely well there in the 1.0 space is providing, as you can see in the chart, providing alpha and idiosyncratic risks for investors, where you get into unique deals. What's happening with the 2.0, and I should stress here that these are not discrete phases. Of course, they overlap in the sense that the 2.0, which is data platforms, the marketplace lenders, they've been operating for 5 years as well in concert, but it's only really now that they're getting the institutional capital. But what 2.0 is characterized by is still the provision of basic credit. So I say it's cash market. If you're looking forward, you could see blockchain and cryptocurrencies, depending on what happens after all the volatility in that space, you could see that there may be a development of more of a 3.0 direct lending, where we use distributed ledger technology to do KYC and all sorts of things which could be done extremely well by blockchain solutions in the credit market. And then 4.0 would really be when the machines take over, if you like, where we use artificial intelligence and smart contracting, so that maybe many of us on the phone here will feel that our careers are under threat. But as I said, this is a long time ahead, and I think there will always be a space for idiosyncratic alpha investing, negotiated investing, and so these things will happen in parallel. What does it mean, though, really for 2.0 right now, which is what I'm going to address for the next 3 minutes? You'll see that I've got a brief chart here which just shows the basic structure of what happens. An SME will be contacted by a direct lending platform. The direct lending platform then has lenders who are increasingly institutional. In fact, most of the market now, most of the investors coming into the market are institutions. Previously, this was P2P technology, and many of the platforms are graduating, if that's not a pejorative term, away from their P2P roots and are really just taking in 10 million or 100 million, or in some cases, $1 billion of capital from an institution, and then going direct to SMEs and providing it. And you'll see just on the simple chart here, the loan goes to the SME, and interest in principal goes back to the lender. The lender here being the institution who's on the platform. Typically, the platforms themselves don't actually take balance sheet risk on the loans, although there is an emergence of some of them who are beginning to do that. The most important thing for people who know direct lending, like David does it here, the interesting thing you may have spotted is you'll see there's a fee here going from the SME to the platform. And the economics of the platform is typically one where the borrower pays upfront fees to the platform. What we're used to in the 1.0 market is, because we feel that we have to have an alignment of interest, is that fees go through to the investor. So for people who are on the line who know the market well, and I think most people are a self-selecting audience probably here and do know the direct lending market to some extent, you'll see here, therefore, that there's a little bit of a difference. Now, what does that mean in terms of alignment of interest? I'm actually going to do a session on this at the Super Return Conference the week after next. So if anybody's there, we'll do it in more detail. We'll have more time. For me, what this all means is very important to go to a chart, which is coming now, which expresses for me how the alignment of interest is still there, even though you don't have the performance fee culture that we have in 1.0. So if you remember the chart there is an upfront fee from the borrower going to the platform. So some of the platforms now have 500 or 1,000 staff. Some of these platforms are are unicorns, unicorns in private value, because what's happening is that the institutional investors are coming in and providing equity capital to the platforms as well in terms of ownership. So as people have probably heard of Lending Club and Funding Circle and Zopa and Market Invoice, and these large platforms are developing. Well, that upfront fee paid by the borrower has really enabled the platforms to develop these very large systems, which in turn is producing large amounts of granular risk for the investors. So investors have been happy to see upfront fees going into the development of the platform, because ultimately it provides more product for the investors. But this virtuous circle I'm going to finish on here is extremely important. The way to characterize this is, you see at the top here, kind of midnight, you have more investors coming in. When you have more investors, you have more capital. Then you have more awareness amongst SMEs of the capital being available. So there are 23 million SMEs of this eligible type in Europe. So one of the leading platforms, which is Funding Circle, I think they've estimated that there's only a 4% awareness amongst SMEs of their platform, although they're by far the biggest. So there's a lot of slack to take up where these platforms can generate more awareness. When they get more awareness, then of course they get more borrowers. Then when they have more borrowers, they have more data, because part of the secret to this is to use data extremely well with constantly improving modeling. As they get more data, they get better modeling. As they get better modeling, they get better pricing. As they get better pricing, they should get performance outcomes and then get more investors. And all of us who were involved in 2005, 2008, during the great financial crisis, will see that almost the opposite of this has happened in credit markets in the past. More capital comes in. Yes, there's more awareness. Yes, there are more borrowers, but the data starts to get distorted. So the problem in the subprime market, of course, is that some of the data was even fraudulent. Some of the data was sketchy. And this meant that modeling deteriorated, and we started to use the rating system in the way that we probably shouldn't have used it, and ratings were masking risks. Then pricing deteriorated, and then performance deteriorated. So the importance here for the platforms is that they show the transparency to investors, and that investors can see this virtuous circle continuing at all times. What I find encouraging about this market, the market, is that this, so far, the transparency has remained. So, for example, one particular investor, which people may have read about in the press, is Aegon Insurance in the Netherlands, has committed, I think, up to 3 billion to platforms, to 2 or 3 different platforms, and they themselves are really buying loans from the platform. So they themselves are performing. They need to have complete transparency as to what they're buying. They also need to have complete faith in the underwriting process of the platform. If they don't understand it, if they don't see it, if they're not able to monitor the underwriting process, then they will lose confidence. If they lose confidence, there won't be more capital. And this will mean that the platform itself, the business, will deteriorate. Now, where's the alignment of interest? The alignment of interest is, as they get in more capital, they get more fees, the companies grow. So you tend to see at the platforms that the real reward for the staff is in equity in the platform, because they don't charge performance fees. In fact, in many cases, they say, we don't charge an asset management fee. They charge a servicing fee, and then the staff themselves have a stake in the platform. So just to finish off, you'll see here, what does this actually mean for an institutional investor? Typically, returns here are, in the kind of mid-single digits for the very diversified SME platforms. This is, though, after losses, because you can apply a loss rate in this market. You can't really do that in the lumpier market. It would be difficult for David to apply a statistical rate of losses. whereas you can in this market. Fees here, the servicing fee is kind of around 1%. You tend to be in there for 8 years after an investment period, which looks very similar to the 1.0 market. Interest and principal is paid through. One key point of the SME market is you'll tend to have personal guarantees of the loans by the owners of the SME. So this is a line of defense which has been very important. So there have been very high recovery rates when there have been defaults. So I'll just finish by saying there that this market is growing very rapidly, and you'll see here that there have been 250,000 SMEs who have already benefited in this slide, and 27 billion of capital. This is versus about 800 billion in the overall private credit market, but this is growing rapidly each year. So I think in some measures I've seen it as the fastest growing part of the market. It's very interesting to see if that virtuous circle I went through can continue and institutional investors can remain confident. Kelly, back to you.
Great, thanks. I think we've gotten, there's one question, the first question we received from the audience actually was asking for what is the appetite for private credit for telecommunication towers in sub-Saharan Africa. That particular sector of the market, telecommunications towers, tends really to come out of infrastructure funds. And I don't know really of very many infrastructure funds that are focused strictly on telecommunications targets, much less telecommunications targets in towers in Africa. I believe most of that activity would really sort of come out of general infrastructure funds or perhaps global infrastructure debt funds, but not necessarily as a targeted area, as I said, even for telecommunications funds overall. Other questions that we have for David. With your particular product, what is the return profile for an investor on a net basis or for investing in you? And how much of that would be from equity kickers, or is it all from coupons and fees?
Sure, Kelly. So, as I said, the overall asset return is about kind of 20%. In general, we're generating between 11 and 12 in terms of cash contracted IRRs on the loans. The loans are generally 3 to 4 year obligations. And in terms of the equity kickers, I didn't mention this so much in the intro for reasons of time, but we work overwhelmingly alongside sponsor-backed businesses. So close to 80-90% of what we lend to are businesses that are usually controlled by a syndicate of venture capital or private equity investors. And we structure our equity kickers effectively to mirror most of the time, when it's practical, the returns that those investors are going to get on their underlying companies. So if a company comes to us and the venture capitalists have a valuation of X on it, we will receive warrants priced similarly to how the investors have invested, and if they make money on their investment, we make money on our warrants. What that translates to over time, and it is, as you can imagine, somewhat volatile, it translates to a blended return of anywhere between kind of 7 and 12%, depending on cycles, timing, NASDAQ, etc., over the long haul. That percent that I'm giving you is an IRR booster that we get in absolute multiple numbers, because the equity kickers take a long time to mature, and they mature when the company exits. So on a different cycle to the loan is paid back per its contractual terms 3 to 4 years, and it might be 8 or 9 years before the warrant or the equity kicker exits, because it will exit alongside the underlying equity investors. It means that the actual multiple impact of the warrants is much greater. So if you look at our funds on a multiple basis, by the way, our funds are unleveraged. I should have said that earlier. We generate anywhere between sort of 1.5 and 2 times on the fund. And a large piece of that, as much as maybe, anywhere from, kind of 0.5 to 1x, can actually come from the warrant on an individual basis. In some cases, we've had warrants produce very, very significant returns, in fact, greater than the loan itself in absolute numbers.
Thank you. And just a reminder to everyone on the webinar, if you do have any questions, You can submit them. There's a Q&A box in the top left of the console that if you're in the audience, you should be able to ask questions on. At the moment, a question for James. With your segment of the marketplace is newer. A lot of it is developed, say, since the great financial crisis. Do you have any concerns about what might happen if we do have another very large recession that has a knock-on effect on defaults, and how that will really sort of impact what's going on in investor interest?
Yeah, of course, in any credit market or in any market which involves risk, you have to have concerns, and if you don't have concerns, you're probably doing the wrong thing. There are 3 or 4 mitigating factors here which I find interesting about that space. As I said at the beginning, this is really where the banking system was all-powerful up until the great financial crisis. And so with many of these platforms, they're catering or providing credit to what you might call community businesses, florists and hairdressers and bakers. So to some extent, these businesses themselves are relatively non-cyclical, and they don't depend on global trade. They don't depend on the capital markets, broader health of the capital markets. They tend not to have a large amount of debt. What they've been given is a 100,000 euro loan to buy a new oven for a bakery. So to that extent, this is interesting for investors like all of us who've really come out of the private equity market. Direct lending came out of the private equity market. Here, it's really coming out of the bedrock, if you like, of Western society. And as I said, there are 23 million of these. So yes, of course, if we have an economic crisis and a recession, you're in some senses in a beta position, or a beta position, as my American co-webinar hosts would say. And in this beta position, you are in these platforms. I think you're taking some risk on the overall economy. So if you think there's going to be a great big crisis, you wouldn't have invested in the shares of banks. This is really the alternative to buying, tier one, tier two investments in banks. Here you're going direct to the SMEs and taking out a lot of costs in between. So that's the first thing. The second mitigating factor, of course, as I said, the transparency earlier. I mean, you're really going to have to be confident that the platform that you're lending through has a constantly visible underwriting process that you're confident in. So there has been stress tests. The third point I would make is there have been stress tests, and actually a couple of these platforms are in the large ones now, and one of them is actually said to have done more lending of this type than the entire UK banking system in Q4 last year was done by one of these platforms. So that platform was stressed in the same way as we've been stressing banks in Europe, and it came out better the lending book came out better than the equivalent bank lending book. Final piece of risk, though, is the platforms themselves. What if their business just stops? What if they just don't have institutional investment or institutional investors? Now that's a risk, because there you may find that the platforms which don't achieve the scale or retain the confidence will not be getting the income in from having new lending, and that's going to cause a problem for those platforms. So I think it's best for investors to stick with kind of the top 10 players and work through that. How does it compare to the 1.0 world? Well, we have risks in recession there as well. I mean, David will manage his risk in certain ways, and we always have to be cognizant of that. But I think it will go through the next crisis and probably come out looking stronger. So a long answer to the question. I hope that's helpful.
Okay. Thanks very much, James. Another question from the audience here is, what is the appetite for private debt in niche strategies within real assets such as mining and metals or timber, and how does it fit into overall debt allocations? When you take a look at those sectors, those real asset sectors, they're actually, the equity side is actually a niche of the equity markets. So there is not a tremendous amount of private equity activity in real assets in those niche sectors. Private credit is sort of a niche within that niche. There are very, very few vehicles that are specifically focused on lending in real assets, and there's at least a couple that I know of that invest in real assets such as metals and mining or timber debt alongside infrastructure debt in a single platform, basically including infrastructure as part of the real asset platform, in order to increase the target market for what they're doing. However, I would definitely say that it's a small niche, and there's not necessarily a lot of activity there. Another audience question: comments about emerging markets direct lending strategies. If you take a look at the second slide in the presentation early on, where it talked about geographies, you notice that there's not much happening as far as private credit in the emerging markets. And the markets there from alternative investment really have been more of an equity market, or they've been a publicly traded equity market. And so there really hasn't been that much activity in private credit. Interestingly enough, most of the activity in private credit in emerging markets has been through special situations funds coming out of the distressed side, though not necessarily distressed in itself. If you note, I said within special situations funds, there's a number of high-yield stressed investing platforms there, and that's where we're picking up more activity in the emerging markets. Also, new question from the audience: how do institutional LPs tend to look for innovation in lending from new managers or existing managers with new initiatives? James, I'm not sure if you want to start off on that. Your experience with institutional investors.
Yeah, that's a broad question. It depends on the type of investor. Very quickly, if you look at insurers, I mean, the interesting thing about insurers is they're able at the moment, at least in Europe, to invest in that kind of 4, 5, 6% return area. So you'll find in that market that they are looking for senior secured investing, and they're prepared. So you don't need to shoot the lights out to get insurance investors in. You don't need to be doing too much unitranche, sub-debt, or second lien. But then the processes by which you generate your credit are going to be under extreme examination. But also, of course, they have their own issues with solvency too. But then with pension funds, you'll find that they're still remaining very opportunistic. And a pension fund, particularly in Europe, may be going into a kind of 18% combined credit and minority equity strategy into the kinds of companies that David potentially works with. But they may at the same time also be going into a 5-6% senior lending fund. I think the overall watchword for people who are starting to work, if there are people on the line who are starting new credit funds or advising new credit funds, generally with institutions, the watchword is integrity. And by integrity, I don't not necessarily ethics, although ethics does matter. What I mean is your story, everything has to add up. The team has to be the right kind of team to source that kind of credit. Your core investors that you're working to have to be the kind of investors who are going to need that kind of risk. I know this sounds kind of obvious, but it's surprising how many groups do start out without their story being completed and without all of these things lining up so that an institution can become comfortable.
A follow-on related question from an audience member: are the loans to SMEs secured?
Yeah, so in the SME lending market, what you might call direct lending 2.0, there are some people who do secured lending, and there are some platforms that do unsecured lending. The two strategies would be as follows. If you do unsecured lending, you're going to be getting slightly higher returns, but you're nearly always going to be getting a guarantee from the owner of the business that if the business fails, they will pay back. Now, of course, this matters in a market like that where the loan is only 100,000 euros. I mean, 100,000 euros is still a lot of money, but for a business owner where typically these businesses have been operating for more than 10 years, also, in the UK where property ownership is widespread, it does mean that the lender can have a lot of comfort that business owner is most likely going to be paying back that 100,000 and guaranteeing the loan rather than having their company default. In the secured lending space, it's harder because with small SMEs, getting security over bakers' ovens and over florists' hoses is not great security. So you'll find there that one of the very interesting areas is actually buying invoices. So there are platforms, I mean, everyone's probably heard of Market Invoice, which is one platform, and then there's another group called Work Invoice. So what's happening there is institutional investors are coming in and buying instruments which themselves are very short-dated, pay high return, and the actual credit at the end of the day is from a large organization which is buying something from an SME and owes them money in an invoice. And so that is a sense of security in the sense that you've got a contract behind it. Generally, though, my favored space at the moment is really the unsecured area, where you're lending to an SME, you have confidence in their business plan, and you're getting a slightly higher return, and you know that the owner is going to pay you back even if the business doesn't.
Okay, thank you. David, one last question, a quick question, throwing it in your direction. What sets private debt funds apart, niche private debt funds apart from one another to institutional investors when you have so many big investors in the market? The questioner mentioned Golub, Ares, Monroe Capital. How do you set yourself apart?
Yeah, I think as I mentioned at the outset, and as James also kind of implicitly mentioned, one of the key things is, how long you've been in the space and the incentives of the management. I mean, very few teams have got, a sort of a 15, 20-year track record. And, that's kind of what you need, to raise money as a niche manager and to justify people, really signing up, for your fund. You have to have that kind of certainty and that kind of history that people can examine. And the names you mentioned are great names, but the individuals who run people's money can move quite a bit within some of those larger institutions, and therefore, you buy the institution, but the market changes. And for the niches, that's where the individual team matters. It also relates to a little bit to one of the questions that was asked earlier. Somebody asked, why do institutional investors go for innovative funds? One of the things we learned running our own, modest small strategy with its own sort of features is that, the vast majority of institutional investors who have invested with us, they come in partly because we have a good strategy and we explain it well and we have all those other things we mentioned. But one of the other things that sets most of them apart is they also usually have a parallel investing activity in the tech or in the growth space. And that's usually crucial to their due diligence. So they look at our loan and they look at our structure, and that makes sense to them. But then they also usually have an investing shortcut whereby they're also indirectly in the equity. And if you're in the equity and you believe in the equity and you have a separate pocket that wants to generate yield, it's a lot easier to believe in the debt if you already own the equity. I'll leave it there.
Great, thanks. Thanks both panelists for appearing and answering the questions we've had. Wanted to remind people who are participants who are still on the line that we'd like you to participate in a survey, if you can, to tell us how you found this and whether or not it was interesting for you. And also, for those of you who are going to be attending Super Return Credit Europe, look forward to seeing you the 24th and 25th in London. Thank you.